Assalamualaikum.
Hi.
How are you two? Hey, gila, you look so happy. You got the money?
I haven't seen Bayuna. Is it not here yet?
I'm fine. I think Bayuna gets stuck in the traffic.
Yeah, I see.
Yes. So we have to wait for her, yeah?
Yeah.
Okay. By the way, what are you reading, Mareni?
Oh, I'm reading this book, The Warren Buffett Way.
Okay.
I read that book too because it taught me about the investment.
Oh, I also read it and I like it. It has helped me making my portfolio investment.
Guys, The Warren Buffett Way is the famous book about Warren Buffett. Is indeed prominent figure in investment. Do you know that? Warren Buffett is one of the most famous and well-studied figure in financial history. In 1993, he was the richest person in America. When you look on the Forbes magazine list of American richest people, he the only one among the 61 American billionaires who made his money from stocks. He had estimated net worth of 8.3 billion US dollar. He was born on August 30, 1930 in Nebraska, America. And the interesting thing is he didn't start out rich. He started with a small investment of $100 and 7 partners who contributed $105,000 to the pool. Over the time, he built up his fortune until it reached $8 billion. Buffett graduated from the University of Nebraska. While there, he read book The Intelligent Inventory by Benjamin Graham. This book so impressed Buffett that he went to New York to study with Ben Graham at the Columbia Graduate Business School. In 1965, he used Berkshire Hathaway as a vehicle to expand into other investment. Every single time, he analyzed the business carefully. This included examining the management and the share value against the earnings. Only after being entirely sure did he decide to invest in it.
Oh, that's interesting.
Hi everyone. Sorry, I'm late. It was raining on my way here, and the traffic got really crazy out there.
It's okay. Bajenda and Ika also just arrived.
Oh, so what are you guys talking about?
We are talking about Warren Buffett. Barani reading his book, The Warren Buffett Way.
Oh, I have that book, but I haven't really got a chance to read it, just the first chapter of it. I heard that it is a very good book.
It indeed. The most highlighted about the book is about the tenants, and people call it its 12 why of the investment from the Warren Buffett Way. Business tenant. Buffett doesn't think in terms of the market theory, macroeconomic concept, and sector trend. He makes decisions about the investment based on how business operate. Buffett concentration on the learning with focusing in 3 main areas. First, business must be simple and understandable. Buffett aware all about the business operate. He understand about the revenue, expenses, cash flow, pricing flexibility, labor relation, capital allocation. Investment success is not matter how much you know, but how realistic you define what you don't know. Invest in your circle competence. It's not about how big the circle, but how you define the parameter. Second, business must have consistent operating history. Buffett buying the company that he believes will be successful and profitable for the long term. Best return achieved company have been producing the same product and services for the long term. He avoid complex and business with solving difficult problem, and it can be more profitable to look for good business at reasonable price rather than difficult business at cheaper price. Third, business must have favorable long-term prospect. Buffett divide the economic world into unequal parts: smart, group business, which is franchise, and larger group bad business which is not worth it to buy. He defined franchise company providing product and services that need or desire, has no close substitute, is not regulated, and have long-term competitive advantage. The definition of great company is one that will be greater for 25 or 30 years. Franchise earn above average return on capital. Commodity business that in distinguish from the competitor generally are low returning business and prime candidate for profitable trouble.
The next principle from Warren Buffett is management tenets. When considering a new investment or a business acquisition, Buffett looks very hard the quality of the management. He tells us that a company's or stock purchases must be operated by honest and competent manager whom he can admire and trust. When it comes from management tenets, that consists of the first is the management rationale. Deciding what to do with the company earning is an exercise in logic and rationality. Earning allocation is linked to life cycle of the company. Next is the management candidate with shareholder. Data needs to be reported to help financial literate readers. First is approximately how much the company worth. Second is the likelihood to meet its future obligation. And the last is how good a job is the manager doing. The last is does the management resist the institutional imperative? Institutional imperative is the tendency of corporate managers to imitate the behavior of others. There are three most influential factors. First is loose for activity, second, mindless comparisons to peers, and the third, exaggerated sense of their capabilities. Hence, for Buffett, good management must have these qualities. First is rationality, candor, and third, independent thinker. So what is management tenets? Management that's basically doing everything to allocate that capital the best way for shareholder, and it's actually candid with a shareholder, meaning that hey, they share the information to us without trying to hide it. And then manager must have integrity and be transparent with shareholders.
Financial tenets. The financial tenets by which Buffett values both managerial excellence and economic performance are all grounded in some typically Buffett-like principles. Instead, for one thing, he does not take yearly results too seriously. He focuses on 5 years averages, profitable returns. He really notes don't always coincide with the time it takes the planet to circle the sun. He also little patient with accounting sleight of hand that produces impressive year-end number but little real value. Instead, he is guided by these 4 principles. For number 1, focus on return on equity, not earning per share. Number 2, calculated owner earnings to get a true reflection to value. And number 3, look up for companies with high profit, high margin. And then, for every dollar retained, make sure the company has created a last $1 of market value. Return on equity. The return on equity is the operating earnings to the shareholder equity or the book value. So, if the company has net income or net operating earnings of $10 per share and the book value is $100 per share, then the return on equity is 10% for that year. When looking at a company's return on equity or return invested capital over a period of years, they typically want to see measurement either steady or increasing over time. A company that has return on invested capital of greater than 10% is great, and it shows that company is efficiency at reinvesting their earnings reinvesting their earnings back into the business to produce even more earnings over time. This is important because Most stocks retain their earnings within the equity of the business. If a company's return on equity or return on invested capital is low or it is declining, it should tell you that the company is not efficient at reinvesting the earnings back into the business. Simply put, great business have a high return on equity and high return on invested capital, say greater than 10%. We have to know that sometimes adjustments need to be made in this calculation. In case, the book might have massive increase in their equity holding in one particular year. Well, this would lead to lower level on return on equity, so that's something to keep in mind when analyzing this figure. We have to keep in mind how much debt a company has on this book. If a company is increasing their return on equity while also increasing their debt to income ratio, we should be mindful while also increasing their debt to income ratio. We should be mindful of this as the company may be getting low to leverage and taking too much of this as the company could eventually become a drag on the company's financial result. When analyzing the return on equity, return on invested capital, or really any reported number by a company, we don't want to put much focus on one particular year because one year might run to be an anomaly. For example, if the return on equity for a company is 5% per year and all of a sudden it's 10% in the most recent year, then you might not want to put much weight on that 10% until you've seen the companies produce that level at least for a period of a few years. Owner earnings. Owner earnings run rate is extrapolated estimate of an owner earnings or free cash flow over a defined period of time, typically a year. It tells us the actual dollar of value a company is expected to produce and have available to spend using current financial data. Owner earnings run rate assume that a company's financials stay consistent, so it cannot be applied to business with lumpy revenue streams. Profit margin. Profit margin gauges the degree to which a company or business activity makes money essentially by dividing income by revenue. Expressed as a percentage, profit margin indicated how many cents of profit has been generated for each dollar of save. While there are several types of profit margin, the most significant and commonly used is net profit margin, a company bottom line after all other expenses, including taxes, and one of audits have been removed from revenue. Profit margin are used by creditors, investors, and businessmen themselves. It's indicators of a company's financial health, management skill, and growth potential. As typical profit margin vary by industry sector, care shouldn't be taken by comparing the figure for different businesses. And the last is the $1 premise. The $1 premise. Buffett goal is to select companies in which dollar of retained earnings is landed into at least $1 of market value. The test can quickly identify companies whose managers over time has been able to optimally invest their company and produce above average return. The proof will be a proportionally greater rise in the company's market value.
All the principles explained previously leads to one big decision: to buy or not to buy the business. And for that, market tenets comes to wrap it all. There are two things on the market tenets. First is determining the value of the business. The world of investment knows two kinds of investors. First is the value investors, and the other is the growth investors. The value investor will focus on a business which has low price to earning ratio, low price to book value, and high dividend value, while the growth investor will focus on the high price to earning ratio and low dividend yields. But for Buffett himself, The discussions and the argument between these two investors are making no sense because for him, growth and value investment is joining at the hip. In the end, it will lead to cash flow. So for Buffett, he believed that the value of the business is determined by the net cash flow over the life of the business, discounted at an appropriate interest rate. What's a proper discount rate? For Buffett, he's pretty conservative in this because he used the long-term US government bond rate. Of course, he will adjust it when the rate becomes too low to normalize the rate environment. Then comes the attractive price. What is an attractive price anyway? For Buffett, he will only buy stock when the difference of the value of the business and the price represented the margin of safety. The margin of safety will protect the business from the downside price risk, but at the same time, it will also provide opportunities for the business for the extraordinary stock returns. In the end, patience and focus are the virtue in Warren Buffett investment. He suggested a 5-year time frame for the economic value of the business to develop. And for the investment himself, a maximum 10 companies with each represent 10% of the wealth is the limit for you to get a maximum return to manage the focus of the investment.
So, Mbak Jenda, what's the key lesson of the investment from the Warren Buffett that we can apply?
For me, is to ignore what's happening on share market. It's not worth paying attention to.
And also, don't pay attention to what's happening with the economy because the economy cycle come and go.
So, Kak, what do you remember the most about Warren Buffett Way?
This is what I remember the most. You are buying a business, not a stock.
And also, choose the best business available when managing the portfolio. There is no need to diversify it widely.
Analyze.
Understand.
Focus.
Long term.
And that's how investment should be made.